Good evening, everyone, and warm welcome to the webinar. My name is Yogesh Devrukkar, and I will be the moderator for today's session. I'm a part of sales team at Quantum Mutual Fund. Let me first thank you all for taking out your time on these weekdays and join us for this session. We request everyone to use the headphones for better audio clarity. In today's webinar, we will have around 30 to 40 minutes of presentation, and then it will be followed by question and answer. You can all post your questions in the chat box once the presentation is over. As you all know, the topic for today's session is riding the bull, risk management in richly valued markets. Before I hand over the control to our speaker, let me quickly introduce you all. The speaker for today's webinar is our fund manager, Mr. George Thomas, a fund manager, Equity Quantum Mutual Fund. George has over 7 years of experience in equity research across multiple sectors. He joined Quantum Asset Management Company in 2016. His prior work experience includes stint at Wipro Technologies and Robert Bosch Engineering and Business Solutions. He manages Quantum Long-Term Equity Value Fund and Quantum Tax Saving Fund. He holds a postgraduate diploma in management in finance. Without taking much of your time, I request George to take ahead the session. Over to you, George.
Thanks, Yogesh. Thank you, everyone, for sparing time to join today's webinar. So the topic today is how can we better manage risk in this kind of a market environment. So when we look at the past few years, we have seen fairly strong returns across many sectors. And it was partly supported by earnings growth. But along with that, in most sectors, we are also seeing an expansion in their valuation multiples. So it is very imperative for investors to be aware about how the environment has shaped up and to evaluate if some of these supernormal returns are sustainable on a continuous basis. So domestically, if we look at it, we have an event which is coming up where we would have the election results a few weeks from now. And globally, if we see, there are early indicators that we could see some bit of rate cuts coming up at some point over the next few quarters. So there are certain events which are coming up, but the critical factor to analyze is how much of that is already in the price and what could be the potential way forward for markets in general. So I'll start with how our value fund has managed many of these risks in its process by itself. I'll start with how the outcome has panned out, and then we'll delve deeper into how the risk management practices are embedded into the investment process. So this chart, it shows how the gross asset value of Quantum Long-Term Equity Value Fund would have happened based on our estimate. So when we look down into the portfolio, every stock in the portfolio has a sell limit, which is typically called the target price in the common parlance. So let's assume if HDFC Bank, let's say the current price is 100, and the sell limit based on the internal research team's forecast on a 2-year forward basis is 120, which means I have a 20% return potential over the next 2 years. And if you assume we have a 10% weight of HDFC Bank in the portfolio, that 20% upside multiplied by 10% weight, it can contribute about a 2% return to the overall portfolio. So if I add up all such return contribution from all the individual stocks, I get an NAV, potential NAV 2 years out. And right from the inception, since we launched the fund, we have been tracking how this NAV would pan out on a 2-year out basis. And this is how that graph pans out. As per this estimate, we should have the NAV should have grown by about 10.4 times in the past 18 years, or in CAGR terms, it has to be about 13.9% on a gross level, including the fee which would the underlying fund would bear. And this is how the actual return has panned out. So the sharp cuts which you see around 2009 and 2020, those are external events like global financial crisis and COVID. Barring that, this chart has more or less trended upwards. And if we look at the actual return which we have realized net of the fee which we charged, it has come to about 11.1 times in 18 years. So against the estimated value of 10.9 times on a gross level, we have delivered about 11.1 times in the last 18 years, which translates to a CAGR return of about 14.3%. So even it has, in actual terms, the actual returns have surpassed what we thought we would have achieved by a marginal basis. And if I superimpose both these lines, the estimated NAV and what we realized, it has been a fairly close fit. So barring global events like GFC or COVID-19, so the two lines have more or less matched, which means the research team knows what it is doing. The estimates have been fairly good. And the process which we set in terms of translating those estimates into portfolio returns, even that is doing, and that has worked out phenomenally. And that's the reason for this very close fit over the last 16, 17 years. 18 years is since the inception. And if I remove the initial 2 years, it is still 16 years of very close correlation between the actual NAV and what we kind of forecasted. So this shows the robustness of the process. Now, I'll come to what are those key tenets at which this fund is designed, and which could how we manage risk in this underlying portfolio. So this is the SEBI disclaimer where past performance may or may not be sustained in the future. But here is a fund which has shown you the track record of predicting what could be the NAV 2 years out and delivering better or very similar returns as we expected. So now I would explain how we kind of achieve this and what are the key risk management elements which are embedded in this fund. The very primary requirement for us for any stock to get into the portfolio is to have a certain minimum liquidity levels. So when I say the minimum liquidity levels, it means for any stock to get into the portfolio or into the portfolio, it should at least have a minimum average daily turnover of $1 million. So which in rupee terms, it would come to around 8.3 crores. So the reason why we have kept such a strict criteria is, so what could happen in terms of illiquid stocks or stocks with very less liquidity is during times of exuberance or in a very high bull run, you might see this stock reacting very highly on a positive side. And the same thing could happen when you try to sell out and realize those value in a bear market or a downward trending markets. So you might seem geniuses in a bull market where, because of those poor liquidity, if more people try to buy those stocks, the stock price can appreciate quite quickly. But the same thing happens in a downturn. So that is one primary characteristics of these illiquid stocks. So if you have an underlying portfolio of reasonable liquidity, you would be able to sell out of those stocks even during stressful times at what we typically see at very close to what is the traded value or the market prices which comes up on the exchanges. So that is one part of the story. The second important outcome of this having a liquidity filter is the current portfolio characteristics which you see at 1,000 crore of AUM, that can be scaled up even if the AUM grows higher. So how do I do that calculation? So for any stock with that $1 million trading volume, so our estimate is generally that can be bought in or sold out at least within a period of 66 trading days. If at all those liquidity characteristics when we initiate that position is maintained through the holding period. So in this case, so if we look at the liquidity profile of quantum long-term equity value fund, so even if we were to grow 10x of our current AUM, there is only one stock which breaches that criteria of requiring more than 66 trading days to liquidate or add position, liquidate that stock, which means 98% of these stocks can be replicated even at 10x of our AUM. And that kind of indicates that the historic performance and the portfolio characteristics can be retained at a much larger AUM. Excuse me. The second important filter which we have is the governance filter. So Quantum as a group has a proprietary integrity screen since 1996. So we are fairly aware of who are the good actors and who have a fairly bad history, or people who have short-charged minority investors over the period of history. And that kind of helps us in selecting companies which have credible corporate governance practices and which have fairly efficient managements. So if we remove all those bad actors, which comes to around, on a rough estimate, it comes to around 30% of many most Indian indexes. We are left out with whatever is remaining out of after weeding out those bad actors. But those set of companies have very predictable earnings profile and return profile. So since the negative of owning a stock which has a bad corporate governance is in rosy times or good times, the stock might perform fairly good. And when the market discovers the management has done something bad, you could see a permanent derating of those valuation multiples, and that would translate to higher losses in terms of stock prices. So the graph here, it shows how the infra index has performed during its heydays from 2004 to 7-8, where there was easy availability of liquidity. There were very strong foreign flows. Debt was easily available. So these companies kind of leveraged and started executing on their order books and built revenues. And after once those heydays are over, when the global financial crisis happened, the liquidity kind of dried out of the system, and they kind of, even market discovered the governance in many of these names were not that good as everyone thought. And there were a lot of shady transactions which happened in many of those companies. So with that, you saw a very rapid decline in the share prices. So this is one of the major drawback of a badly governed company, where you could see rapid share prices for very little reason, which could take the stock very high. But as and when the market discovers and those proofs become very evident, we could see a very rapid destruction in terms of the investor wealth. And by incorporating this governance filter, we ensure such things does not happen, and we would be able to reasonably earn good compounding returns over a long time, and managements and investors benefit from those earnings compounding in those companies. And with the value fund, what we typically do in terms of the buying process is to buy the company at a discount to what we estimate as its fair value or intrinsic value. So any company, let's say Hero MotoCorp or Bajaj Auto, whatever be it. So if we see the 2-year forward estimate of that fair value of that company is, let's say, 100 rupees. So if I am able to buy at 75 or less, that makes it way to the portfolio. And the second important criteria in this, while we look for discounts to fair value, the second important factor which we see is there should be a catalyst which would take the share price from 75 to 100. So once we kind of identify those catalysts and we get those stock at a discount to fair value, that makes its way into the portfolio. And the good part about this process is you would always have some margin of safety when you initiate a position into the portfolio or whenever you add stocks into the portfolio. So even if the earnings growth does not pan out to the level which market expects, because of that extra cushion in terms of lower valuation which we tend to buy, there is some gap in terms of absorbing those minor disappointments. So if a stock is priced to perfection and it's factoring all rosy picture, even if when the market sees slight disappointments, the share price reaction could be quite sharp, which may not be the case in many of our holding companies. And an important criteria to sell is whenever the stocks breaches our fair value estimate, we start trimming positions or still moving out of that stock. And the other case is if we have a changed view of management, or if the management endures into governance practices which are not conducive for minority shareholders, we might sell out of the stock much before it reaches our sell limit. But otherwise, whenever the stock breaches our fair value estimate, we start trimming the position. And this ensures that if there are any sectors which have trading at euphoric levels or where market is overly optimistic, the process ensures that we will not stay invested in such sectors to a large extent. There could be cases our estimates could go wrong, but that would be a very minority kind of cases. In majority of the cases or the bulk of the cases, this process ensures that there is enough headroom to absorb shocks even if the market expectations are not met by way of the valuation comfort at which we buy. And the discipline which we follow in selling ensures that even if there are certain segments of the market, let's say for in the current instance, there are certain themes like defense, where investors are overly optimistic, or some of the themes which are related to capex recovery and things, some of the capital goods themes and stuff. So those segments where market is extremely bullish or where valuation multiples would be very expensive, the process ensures that we would stay away from such sectors. And this is reflected even in our portfolio characteristics. If you look at our PE ratio, which is the valuation multiple at which the underlying portfolio trades, it is at an 11% discount to what the index trades. The PE ratio is at 16.1 compared to about 18.1x of the Sensex on a 2-year forward basis, with a fairly similar earnings profile. The earnings growth is not materially different of our underlying companies. It's not that our companies are not growing and therefore it is trading at a lower valuation. They have reasonably good earnings profile or earnings growth, but they are available at a good discount to how the index trades. And these portfolio characteristics are based on the consensus estimates of sell-side analyst. If we were to estimate, probably we might turn more optimistic on our portfolio companies. To avoid such biases, this characteristics is derived based on the sell-side consensus estimates. Sell-side consensus estimates of our portfolio versus sell-side consensus estimates of the index. And with that estimates, we are seeing our portfolio is fairly well positioned. Even if we were to adjust those lower valuation ratios to the earnings growth profile, our portfolio is still favorably positioned on a PEG basis or price earnings to earnings growth basis. So when we look at our cash level, this is another important factor which shows how we manage risk in a bull market or markets where the valuations are on an extremely high side. So if we look at these are the month-end cash levels of quantum long-term equity value fund. And the red line kind of indicates where the typical cash level lies of any fund, which is around 5%. So because of the disciplined process we follow, what typically happens is if market turns overly optimistic, a lot of companies are trading at very high valuations, we typically tend to raise cash levels. And that happened in 2014 when market was turned overly optimistic when Mr. Modi was re-elected. And that led to a very rapid rise in markets. But then later, market came to terms in terms of in what could be the realizable earnings growth versus what the market anticipated. And then the market corrected and we started deploying and hence our cash levels came down. So whenever markets turns euphoric, when the valuations for the overall market or many sectors turn expensive, our sell limits get hit and we would start trimming our positions. And therefore that in itself has some kind of a risk protection mechanism. And if markets were to turn very attractive like the global financial crisis or COVID, our cash levels can come down very quickly. We tend to act fairly fast in terms of deploying into the markets as our required upside potential is seen, and that ensures that the cash level gets back to very minimal level. We have gone as low as 2% when during times when valuations were very attractive. So if you look at our portfolio position even now and historically, we are not averse to staying away from any sector because the valuations are very high, or we feel the underlying earnings profile of the company may not justify the valuation multiples at which they are quoting. And this is very evident even in the current portfolio positioning. If you look at consumer staples where valuations are upwards of 60-70%, we have never had a position in that sector because the valuations have been overly optimistic or not quite disconnected from the underlying fundamentals of that company. The same has happened with industrial sector right now, where market is quite bullish, but despite the index having a reasonable weight, it doesn't get into the portfolio. So if markets were to see an overall or a broader correction, these are some of the sectors where valuations are in excess, which could see higher than market correction. And being not present in those sectors by itself gives us some cushion or downside protection to that extent. So to recap, what we do as an investment process is we follow the value style, and there are two major criteria apart from valuations which we look for any company to get into the portfolio. One, it has to clear our integrity screen. The governance standards has to be top class. Number two, it has to have a certain threshold liquidity levels or market turnover levels, which we call as at least $1 million or 8.3 crore of average trading volume. And that would ensure that we don't get into illiquid stocks, which reacts very sharply on our buying or selling. And number three, we need to get the company at a discount to what we estimate as its intrinsic value. And we engage a variety of methods to ensure this process is followed intact. We analyze the companies and the business environment to understand the catalyst which we identified and how that could pan out over the period. And this is a fairly simple example of how we have executed the process in the past. So Cummins India was part of the portfolio some time back. And during COVID time, they are into the manufacturing of diesel gensets, which is majorly employed in those power backup systems. And during COVID time, the market was kind of doubtful about how the demand environment would pan out. But our reading from the ground was this is a fairly critical application to ensure that a power backup is served to very critical industries like IT or hospitals and or even the telecom towers and things. And therefore, even if the demand were to moderate a bit in the near term, it's very unlikely that the demand destruction would be sharp. And number two, it cannot remain low for a longer time because of its essential nature. And as our thesis started playing out, and that's that translated into the earnings profile and revenue profile of the company, the market kind of realized the disconnect with its initial thesis, and the stock started reacting. And very recently, few months back, when the stock breached our sell limit or the estimated fair value on a 2-year forward basis, we kind of got out of the stock. So this way, as the stock turns very expensive, or when the market in general becomes very optimistic, we tend to get out of such names, and that by itself would ensure that we hold a portfolio of reasonably valued companies. So when you look at how a fund needs to be evaluated, so in our typical process, when we sell out of companies as it turns expensive, what an investor can estimate is we would participate in the most part of the bull rally, more so in the initial part of the bull rally. And as market estimates or the stock prices turns quite unreasonable, many of our underlying stocks would start hitting their sell limits, and we would be trimming our positions. So our performance might trail what the index could report. And on the downside, because we have a set of companies which are well governed and where there is a margin of safety, and if since we are trimming the positions during the late stage of bull market, we would be sitting at a reasonable amount of cash levels, which we can deploy at more attractive valuations. And because of that, the downside tends to be lower than what the market could typically report. And in the bull market, we typically capture most of it, but may not participate fully in the tail end of the bull market where valuations are very optimistic. So if you look at a cycle, how a market cycle happens is the market goes to the top and then it comes down. So that number one and number two, this comprises of one cycle, and likewise, it continues. So if we analyze our performance in multiple market phases, so we have been able to achieve what we kind of endeavor to achieve. So if you look at most bull markets, let's say November 2009 to 10 or December 11 to March 15, we have fairly participated in those upside rally. And whenever the market crashed, we fell much lower than what the indices fell. And because of our liquidity filter, we tend to be slightly large cap biased. So if we look at comparing Sensex, our performance has been much superior. So you capture less of the downward trend, then you kind of capture reasonably good upside. And that is how we ensure that we have a good performance over the long term. And there is an exception in the 2016 to 20 period where the underlying economy was not growing that well and market was totally disconnected for a prolonged period of time. But even that reversed post-COVID when the next leg of economic expansion happened, and our performance track record has also caught up after that, after the period. So generally, our process has worked. If you look at our estimated NAV versus actual NAV, the upside potential charts, or how we have performed across multiple market cycles, even including the current ongoing one. So we have performed reasonably well. A lot of times it could be masked before because we tend to be more large cap biased because of our liquidity profile. So if there is a phase where mid and small caps are in very euphoric levels, you could see if we compare, there could be some bit of deviation, but generally comparing to the large cap indices or the broader markets on a longer term basis, we have performed reasonably well. In most cases, most rating agencies or websites look at trailing returns, which may not be the right way to assess how a fund performs, because it's from an investor perspective as well. It is not just one point where you invest and get out. It's a continuous process. So this table shows how the Sensex and Quantum Long-Term Equity Value Fund has performed on multiple rolling cycles. When I say rolling cycles, it means, so standing in April 24, the first rolling cycle, 3-year cycle would be April 24 to April 21. And as I move 1 month back as March end, it would be March 24 to March 21. So likewise, if you take those multiple 3-year or 5-year, 7-year, 10-year returns and see how we have performed versus index, versus what we endeavor to achieve, which is on a, assuming that we buy stocks at a 25% discount, it comes to about 15.5% on a gross return on a 2-year basis. On a net basis, net of fees, it should be around 14.5%. So if you look at the percentage of cycles where we have kind of achieved around those levels of more than 14% return, our numbers are much better compared to what the index has achieved, which means the way we estimate our upside potential or the future NAV and the way we could translate that to the portfolio, that has worked phenomenally well over the historic periods. So in summary, so we have a fairly sensible product which has many risk management metrics embedded in that design by itself. And if you visualize your overall portfolio, how it should look like. So within your equity allocation, this can be considered for a base allocation on the base of the pyramid, where you would get fairly stable performance over the long term, and that could form your base of your equity allocation block, which would ensure that that entire asset allocation is fairly stable, even if markets were to turn volatile or you go through multiple market environments. So this is broadly our asset allocation framework. So where we advise every investor to have an emergency corpus, which could be 12 months of your monthly expense or 6 months of your monthly expense, depending on your job profile and how vulnerable your primary earnings profile is. And the remaining portion, which can be allotted to investments, can be divided between equity and gold in the ratio of 80 and 20. And the reason why we suggest a combination with gold is, so historically what we have seen is gold and equity has fairly negative correlation. So during crisis periods like global financial crisis or COVID-19, or when central bank policies go haywire, you would see gold appreciating, but in those times, equity could be slightly volatile. So a combination of equity and gold kind of helps. And even within the equity block, so if you look at the value style or the way Quantum Long-Term Equity Value Fund is designed, it is designed very well to withstand a lot of risk which is possible in the market environment. And therefore, that could be the base of your portfolio. And as you go up the equity pyramid, the return potential goes up. Along with that, even the risk which you assume goes up. And the Quantum ESG fund, it follows ESG practices. And if I look at the characteristics, it kind of mimics a growth fund. And even small cap fund, which is designed very well to avoid some of the risk which is very highlighted which is very high in the industry, which is buying out underlying stocks which are very less liquid, which could become very difficult to liquidate in a stressful market scenario. So with all, as you go up the pyramid, the risk profile increases, along with that, the return profile increases. And this, if you consider all our products, they are well thought out. Risk risk practices and risk management is very well embedded into all these processes in all these products. And that is visible even in our outcome. So this is based on the actual return and risk profile of these funds since their inception. If you look at quantum long-term equity value fund, the standard deviation or the risk, which is popularly used as the market metric to measure, which is not a criteria for us to enter or exit a stock. So if you look at even at that perspective, QLTVF or the quantum long-term equity value fund has a lower risk profile than the large cap index and manages to get slightly better returns. So with that, I'll end my presentation and I'm open to any questions you may have.
Thank you, George, for the insightful presentation. We'll request all our investors to post their questions in the chat box. In the meantime, we already have received a few questions via email before the webinar. So we will start that first. My first question to you, George. What specific strategies can be employed to mitigate risks associated with the overvalued equities in a bull market?
Yeah, so in a bull market, what could typically happen is, so first of all, you need to evaluate your asset allocation. So let's say based on your risk profile, you had assumed your portfolio can be 70% large cap and 30% small cap. Since small caps had a fairly strong rally in the recent times, it could be very well possible that your small cap allocation could have breached those desired allocation limits, and that would increase your portfolio risk to a large extent. So wherever that has happened, it makes sense to rebalance the portfolio to its desired weight. So that is one risk management which you need to do. The second thing is to analyze how the underlying funds kind of manage those risks. So if you look at some of the small cap funds in the industry, you might see cases where some of their top holdings takes years to liquidate. So if that fund house were to liquidate some of their top holdings in top 10, it could take them maybe 9 years, 10 years, or even more than that to liquidate that stock. So what that could happen is if market were to turn its direction, so if he tries to liquidate such positions, there would be a very rapid price decline and you're at the risk of a higher than market decline in terms of your returns. So one is to rebalance your asset allocation in line with your long-term allocation plan. And number two is to understand funds in the industry, which are kind of how they are managing the underlying risks. If they are investing in very liquid names, or if they have a practice of investing in companies which has a weak governance standard. So all of these may not be noticed in a bull market or a rising market, but it becomes very prominent as the market turns its direction. And if you have a very disciplined process like quantum long-term equity value fund, where we sell out of stocks as market turns expensive. That in itself is and we kind of translate that to cash and redeploy at attractive valuation levels. That in itself is a risk management technique which we have embedded in the process. So understand such techniques which are behind your fund and kind of reassess your portfolio.
Thank you, George. Our next question is, how can diversification help in managing risks, and what types of assets or sectors should be considered in this richly valued markets?
Yeah. See, how diversification helps is if you have a fairly concentrated style or even in terms of portfolio, if you have a fairly concentrated portfolio where you have not distributed your weights in a well thought out manner, there could be periods when certain styles might go unfavorable. So let's assume if economic growth goes through a downturn and earnings growth takes a beating, there is a very high possibility that the growth stocks or growth style might take a larger beating because most of those names would be priced to perfection. So even if there is a slight disappointment in terms of earnings growth, you might see very rapid declines in those valuation multiples and in turn the stock prices. But if you have a mix of value and growth style, those value part of the portfolio can withstand some part of those shocks to a better extent. So that is one kind of diversification which you need to do, where you invest in multiple styles. And the same is true for even multiple segments of market cap. Most of your allocation should be in large caps, which can relatively better handle downturns. And as you go up the pyramid, as your risk profile increases, the allocation should ideally reduce. That is one kind of diversification. The second diversification is with respect to asset classes. So the reason which we suggest a combination of equity and gold is when market turns adverse, you have an option that your gold might be resilient if it is due to macro issues, because generally gold tends to perform well when there are broader macro risk playing out. And even at an attractive level, so let's say if you have a 20% allocation and if gold does well and equity does poorly, your gold allocation might go to 20 or 25%. Then you get an opportunity to even rebalance back to equity at better levels. So one is to have a mix of multiple styles, market caps, and all of that. The second option is second diversification which you need to have is to have diversification between different asset classes.
Thanks, George. We have one more question. What are some simple ways to protect the portfolio if market started falling? Okay, since the market is now very higher level now, how can an investor protect their portfolio?
Yeah, see, so if the market falls, it is very unlikely that your portfolio does not fall to that. Does not fall. It will follow a similar trajectory. But the only point is if you have proper practices in place, the downfall can be a lot lower than the market. So some of the practices which I discussed, so that would make sense. One, if you allocate more part of the portfolio to more liquid names, where the distraction could be relatively lower if the market were to turn its direction. So that is one way. And again, you should be cognizant of valuations. So in a bull market, what typically happens is there could be a lot of themes which are painted, and that could take many stocks to, let's say, high double digits, or even there are certain stocks which trade at 3-digit PE multiples of valuations. So those may not be sustainable on a longer term basis. So investors should analyze such underlying themes, or if your funds are investing in such themes where a lot of hope is built into those price, then that could be a recipe for disaster. So one is to have, let's say, more exposure to more liquid names, and number two is to see if the valuations of those underlying stocks are at least on a reasonable range. But this all of these has to be done relative to how the market matrices span up.
Next question is, how often investor should review his portfolio to manage risks in a highly valued market?
See, so if you reevaluate your portfolio, so most often what we have seen is, if we kind of reject the portfolio or take very frequent actions, it may not be a beneficial practice, because you might end up doing the wrong actions, or you might be selling out of any fund at the most disadvantageous time. So if you review your portfolio twice a year, that should be fine. But of course, if a large amount of returns come out in a short period, so you can always evaluate how your relative weights between equity and gold or equity and debt has panned out. And if any rebalancing is required, you can obviously do that. Or if your small cap funds have become a very large portion of your portfolio, it makes sense to reallocate some of that to the large cap funds, where you could have a better downside protection.
Right. So in a year, twice a year is a ideally better option.
Correct. But if you see a period where you get a very high returns in a very short span, like what you could have seen in the last few months, it makes sense to reevaluate and see if your designed bands based on your risk appetite is kind of maintained.
Right. Okay. Our session is going on very well. We are getting quite few more questions. Next question is, how do you adjust your asset allocations during the period of high market valuations to manage risks?
Yeah, I think we already answered that. So it's very similar to what we have discussed in the previous questions.
Next question is, what risk management strategies do you currently have in place to protect the portfolio from significant loss in the valued market? I think you also answered this question, but again, we have received this question. Hello?
Yeah. See, it's a very, so since we have a fairly disciplined process in terms of adding new names at a discount to its intrinsic value, or what we estimate as a fair value on a 2-year out basis, and trimming positions where we believe the valuations have turned unfavorable, or when the stock hits our fair value estimates, that in itself protects our downside to a large extent, because we stay away from names which are more names or sections of market which are more vulnerable to a rapid correction. That is one thing. And number two is we operate in the liquid part of the market. And that's why you would mostly see our large cap allocation quite high in most times. And even there, because of highly liquid names, on a sustainable basis, if we see, we would do much better than how the broader markets would perform.
We have received one question from Vishal Vithalpura. He's basically asking about the liquidated period that you said, key 66 days. So what he want to ask, at what cost? And does it really easy to liquidate in 66 days?
See, it depends. The easy or difficult part of liquidating in 66 days, it depends on the kind of stocks which we select. So for us, for any stock to get into our portfolio, we look at a minimum 1-year average trading volume of 8.3 crores, so, which is about $1 million. And if we have that kind of a trading volume, and if the trading volume remains at those levels, it is very much possible for us to liquidate that in a short span of time. So the advantage with holding such liquid names is one. So if you hold a stock which is very illiquid, or let's say has very less liquidity, so in a market downturn, what typically happens is the very act of trying to sell that stock will itself depress that share price to a large extent. So if you try to sell a stock which is very illiquid in a bear market, you would see that your act of selling by itself is crashing the price. But in our case, we don't even at the start or when we initiate a position, since we have the liquidity filter, so the kind of volume which we need to offload does not become a very large part of the market volume which is traded, and therefore the price impact of our buying or selling is not very high. But it could be a possibility that it might be a problem when if you invest in the illiquid space, like some of the prominent small cap funds have done. But that is a risk which we are very conscious of, and we try to avoid at the when we initiate a position. So if you look at our AUM as of April 2024, there is hardly any stock which takes more than 3 weeks to liquidate, assuming the current market liquidity levels. So even if we assume the liquidity comes down at some point, still we are at a fairly reasonable liquidity profile. So even if we were to scale this portfolio to 10,000 crores, the liquidity profile still remains fairly intact. So we would still be able to liquidate most of our portfolio in a fairly short span or less than 66 days of trading days.
We have received one question from Riyaz Sayyed, which has already been discussed earlier. So we are not taking this question now. We have one more question about any specific sector that we are selecting a stock, or any group stocks that we are taking into our portfolio.
See, I don't want to discuss specifically on stocks at this point, but one of the recent additions which we made into the portfolio was a private sector bank, because from a sectoral perspective, private sector bank is one space where we are seeing a certain valuation comfort, and there is a good amount of upside potential in many of those names. So since one of those private sector banks met our valuation criteria, came into our buy limits, we have started initiating a position. But other than that, there is nothing as such to call out.
We have received one question from Bhavesh Kumar Patel. He's asking how is possibility of return in calendar year 2024.
Right.
He's basically expecting returns that we can generate or expect in 2024.
Yeah. See, I will not be able to, I don't want to comment on specific return numbers, but the broad framework at which, so we generally look at the 2-year out upside potential, which has given us a good indication of the potential returns over the next 2 years. So right now, it is at the lower end of what we have seen in the historic range. So what we saw in the last 3 years or 5 years, it may not be representative of the kind of return potential which an investor should expect in the next couple of years. Clearly, the return expectations has to be moderate, and it is always advisable to invest in a staggered manner at this point. And if the market turns very attractive, you can increase the contribution at that point in time.
We have received one question from Syed, Riyaz Syed again. Basically, he wants to know about our SIP. So, in looking at the current market levels, what is the better option, whether to invest lump sum or whether investor should go for SIP route?
Yeah, staggered investment is advisable at these levels. So even if we were to see some bit of volatility, the investor would have some room. He would benefit from that averaging out phenomena, and his average valuation at which he enters would be reasonably good. So considering the current environment, staggered investment is advisable.
Right. Okay. Then we have one question from Krishnamurthy Sukumar. He's asking, you have mentioned about the targeted sell trigger with the Cummins example. You have given the example of Cummins. When the particular stock is on the upswing, is it prudent to adopt this kind of fixed strategy as further upside is in the stock could be become missed opportunity? You can miss the opportunity also.
Right. Yeah, this is one mistake which we realized a few years back, where when our stock, when a particular stock hits our sell limit, we would have sold out the entire quantity. So what we do right now is we start selling at the sell limit, but we sell in a fairly staggered manner, because in most of our portfolio names, the business underlying business quality is fairly strong. And so, like you rightly said, if the earnings trajectory is on an upswing, it's generally possible that the stock could move higher for a longer period of time, and it would take a long time for that stock to get back to a buy limit and again come into the stock, come into our portfolio. So what we do is we start selling at the sell limit, but we do it in a staggered manner. We do not completely exit at the sell limit, and as the stock keeps moving up, we kind of keep trimming and kind of ensure that our average, in most cases, our average selling price would be better than and what we estimate as our sell price. But these are only for high quality names like Cummins. But there could be companies where we do not, which are cyclical in nature, or where we do not perceive them to be at the top notch quality. There, we may not take this risk of staggered selling.
Okay. Then we have next question uh, from Madhusudan. The current NAV of Quantum Long-Term Equity Value Fund is almost at 115, a new peak of sorts. Okay, so it is really prudent to enter at this level more. So lump sum bulk. The first year means basically he wants to know ki, again ki lump sum will be the better options or whether the stagger investment that we can do in the same fund. So as you already answered this question, but again, you want to know the what exactly he can do.
Yeah. See, so like I alluded earlier, uh, yeah. So the point is, obviously, like you said, in a bull market, you would always get the feeling of missing out. But so if I look at our upside potential, which is a fairly, which obviously I cannot give out the number because of regulatory reasons. But if I look at the range at which it lies currently, it is not as good as what we saw 2 years back or a few years back. So clearly it is at a lower side. So the return expectations needs to be moderate. So you could consider doing a staggered investment, and at any point in time, if market turns very attractive, you can you can consider investing a larger portion of that lump sum at that point in time. But at current point, it is advisable to do a staggered investment. And but obviously, it's anybody's guess on how the markets would behave as we move forward. But clearly, when we look at valuation versus the potential earnings trajectory, the earnings trajectory is reasonably okay. But because of the recent bull run, the valuations are looking stretched in many pockets.
Now we have one question from Prabhakara Rao. He wants to know the taxation of gold fund.
Yeah. Yeah, the gold funds in the current regime is taxed at the marginal tax rate. So whatever tax rate the investor is in, the gold fund would be taxed at that rate.
Okay, to with this, we have answered all the questions, George.
Yeah.
Mm. I'm just checking is any further question. I think we don't have any question. Uh, so thank you, George,
Yeah.
for this insightful presentation. Uh, we'll request all our investors to post their questions in the chat box if you have. In the meanwhile, we have already received some question, but we already answered this. Um, so, any closing comments from you, George?
Yeah, so like we explained in the presentation, so we have seen fairly strong returns in the last few years. So it is uh, very important for investors to understand that how the risk is properly managed in your underlying funds. Because in a bull market, a lot of times the risk matrices, which are the risk management practices which are built into the fund, it goes unnoticed. And if the market were to turn, you might see many of those underlying risk which are embedded in many of the peer funds kind of playing out. So understand your risk management practices which are embedded in the fund and invest in a fund which has those proper frameworks for valuation, governance, and how they manage the liquidity risk. And it's also important to evaluate your portfolio on a holistic level. And if the allocations have become skewed to certain segments, it makes sense to reallocate to have a balanced experience over the long term. Thank you, everyone, for joining the session.
Yeah. Thank you all for your comments and questions. Further, for any questions to be answered, you can call your RM or you can write us at customer care at quantummc.com. We will be happy to answer your questions. Once again, thank you everyone for giving us this time to us. Stay safe, stay investing, happy investing to all of you. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.